Hey, what's up, bubs? Welcome to the Basic Concept. Today's topic is the stock market. Now, this video is kind of long. There's a lot to cover, so let me start by saying what I will be covering in this video. I will be covering 10 topics on this video. The first one is what is the stock market? Now, I'm a big believer of knowing the basics, hence the basic concept. So, this is a logical starting point. Second, I will be covering how the market works, how to make money in the stock market, how dividends work, the different types of stocks, indexes, mutual funds, brokers and their platforms, different account types that you can have, and finally, picking stocks. If you like the information in this video, you can help my channel grow by hitting the like button, subscribing to the channel, and sharing it with people that can benefit from this info. So what is the stock market? Well, the stock market exists because companies need capital for new products, research and development, expansion, globalization, acquiring new assets or new companies. When this happens, companies can go public, and when their stocks are sold, they get the capital they needed. Basically, the stock market is a literal market where buyers and sellers go to trade shares in companies. When you buy a share in a company, that share represents a percentage of ownership in that company. That percentage varies depending on how many shares are available, along with some other factors. So how does that work? Well, the very basics behind it is supply and demand. When a company goes public, they value their company at a certain price, and then that price is divided by the number of shares they will be willing to offer. When you buy a stock, you are trading money for a percentage of ownership in that company. If the price of the stock goes up, you can sell it and make some profit. The goal is to buy low and sell high. There are other strategies of making money as well. There are several ways or strategies to make money in the stock market. Here are some of the basics behind most of them. As mentioned earlier, you can buy a stock that is priced low, wait for it to be priced high, and sell it to make a profit. Alternately, you can borrow shares to sell high first and then buy back when the price dips. This one is a little harder to comprehend since you are selling something that you don't own yet. Most brokers, however, will allow you to short a stock by selling shares you do not own. Basically, you are borrowing shares from the brokerage. The goal is to buy them back at a cheaper price and return them to the lender, keeping the difference as a profit. The third way of making money is actually topic number 4, dividends. Some companies offer a payout called a dividend. It's essentially a profit-sharing method that the company uses to attract or retain their investors. Dividends are calculated per year, but mostly paid out quarterly. Some companies do also pay monthly. For example, Apple, at the time of recording, has a 1.38% dividend yield, or $3.08 per year. It's paid out quarterly, meaning every quarter they pay out 0.345%, or 77 cents per share. If they did pay it out monthly, it would be 0.115%, or 0.25 cents instead. Now you can either cash this dividend out and take it as income, or you can reinvest it. Most brokerages will offer some type of a DRIP program or dividend reinvesting program. This allows you to leave your investment on autopilot. The program takes the dividend money and buys more shares with that money, often ending up in fractional shares. You will get tax benefits this way. With some companies paying as much as 25% dividends per year, you can have $1 million account in just over 16 years with just $500 contributions. Stay tuned at the end of the video where I do cover the pros and cons of picking stocks. There are some different types of stock. For example, there's common and preferred. Common refers to commonly purchased stocks. Preferred stocks do come with some benefits. For example, certain stocks will offer a perpetual dividend for owning their preferred stocks. Some companies do choose their own classifications of their stocks. They can customize voting or other aspects of them. For example, they can say Class A stocks offer a 1-to-1 ratio for their voting system, whereas Class B offers a 2-to-1 or a 3-to-1 or a 5-to-1 or whatever that percentage might be. That means that Class A owners have 1 vote per share, versus Class B owners can have 2, 3, or up to as many as they decide. So what is an index? Well, a stock market index is essentially a collection of stocks. It's essentially a way to measure how a certain sector of stocks are doing, or a way to invest in a certain market. Dow Jones and the S&P 500 are probably the best examples of an index. The Dow, or the Dow Jones Industrial Average, is an index that's comprised of 30 large cap companies. The list of companies in any index can change. As of this recording, Dow Jones includes the following companies. You should be able to recognize some big names like Apple, American Express, Coca-Cola, JP Morgan Chase, Microsoft, etc. As I mentioned earlier, indexes have a variety of purposes. Generally, in the media, they're used to gauge how a certain market is doing. For example, when they're talking about the S&P 500, they're talking about US stocks, the top 500 of the largest US stocks. This ends up being about 80% of the whole US stock market in terms of capitalization. And that is why the S&P 500 is considered to be a good indicator of how the market is doing as a whole. Indexes can be as broad as the whole global market or as niche as the Gamer Index, which only has companies that are involved in gaming, like Activision. Indexes are generally passive. That means there's not an active manager assigned to them. Mutual funds are very similar to indexes. However, most mutual funds are actively managed, meaning that there is someone picking stocks and bonds to be in that fund instead of just picking a general index. Managed funds works by collecting fees for managing the fund. Mutual funds are generally a mixture of stocks and bonds. Because of that, they are generally less risky than picking single stocks. However, the fees that they charge can sometimes offset or completely wipe your profit. Continue watching for number 10 to see my opinion on picking stocks or mutual funds. Let's talk about the brokers and their platforms. I'm talking about companies like E-Trade, Vanguard, Fidelity, Robinhood, Webull, all these companies. While they're very similar to each other, there are a few differences between them. One of the major differences is how they make their money. For example, E-Trade charges a commission each time you make a trade. That charge is $6.95 per order. So for example, if you bought 10 shares of Apple, that will cost you $2,209.60 for the actual purchase of the shares, plus a $6.95 commission to E-Trade. Let's pretend that the price of Apple went up to $230 per share and you sold it. You would get back $2,300 and then pay another $6.95 for that trade. Your net profit in that deal would be your selling price minus your purchase price minus the two trade commissions. So you'd end up with $76.50. Now I've been with E-Trade since 2004 and I love their platform. It's very familiar to me. I know where everything is, but currently I use Webull or Robinhood, mainly because neither one of them charge any commissions for trading. So if I use Webull to execute the trades in the above example, I would avoid the two $6.95 charges and my total net profit would be $90.40 instead of the $76.50. In the stock market, we're always chasing a higher percentage return, and that alone right there is 18% higher. Webull, Robinhood, and companies like that make their money similar to a bank. I have a video explaining how banks work. I'll leave that in the description below. On top of the no commission trading, these companies do offer additional benefits for signing up with them as well. For example, if you signed up to Webull using my affiliate links below, you will get 2 free stocks. One, for using my affiliate link, you will get a stock between $8 and $1,000. And the second one for simply just signing up, and that's valued between $2.50 and $250. So by using my affiliate link, you can make up to $1,250. On top of that, once you've signed up, you can use your own referral code for your friends and family, and each time someone signs up using your link, you get an additional free stock. That's in addition to your friend or family getting one as well. Now each one of these could be valued up to $1,000. Robinhood has a very similar program. I'll post my affiliate link in the description below. With this one, you'll receive a free stock valued between $2.50 and $200. And similarly, you can reshare that with your friends and family and gain additional free stocks. Other differences between the brokers are going to be their funds, their fees that they charge, their support system that they have, their platform and how easy it is to use, and if they allow other account types. Yes, there are a couple different types of account. Your normal brokerage account is a basic one designed for simply buying and selling stocks. It can be a cash account where the only way you can buy something is if you have the cash available in the account. Or B, a margin account where the brokerage may lend you the money to buy or sell shares. You must have a margin account for shorting stocks, trading options, and trading futures. Margin accounts are mainly a safety net for the brokerage since you can create a lot of trouble trading those. For advanced strategies in the stock market and retirement accounts, I will have videos coming up. Hit the like button, subscribe button, and notification bell so you can get notified when the new videos are up. Also, this helps my channel grow so I can continue bringing information to you. And finally, let's talk about picking stocks. There are plenty of financial advisors and mutual fund marketers that will tell you that they have the art of picking the right stocks down. I'm here to tell you that it's pretty much a marketing tactic, and more often than not, it's just a flat out lie. No one can predict the stock market consistently. Sure, firms and funds get lucky from time to time. Sometimes this luck even continues for years. But that does not mean that they know what's going to happen next. Every single broker and their platform will tell you this one statement when they're providing quotes and historical data for you. They'll say that past performance does not indicate or guarantee future returns. So if you can't trust these stockbrokers and these expensive mutual fund managers, how do you decide where to invest? You can do what Warren Buffett does, which he actually digs into the business itself before he looks at the price and then decides whether the price is on sale or not. That is something I'm personally not good at. Although I have been lucky with stocks like Home Depot, I was able to purchase it for around $30 a share, but that's getting lucky. For that reason, for me, index funds are the best place to put my money in. If you pick stocks based on dividends or past records, you are risking more than you need to. You could pick a wrong company based on their past performance. For example, GE was trading at around $30 a share for a very long time, and currently it's under $10. Same thing with dividends. Dividends are only a thing if the company is profitable. You'll hear a bunch of people say, oh, mutual funds are safe. They definitely are, but that safety comes with a price, in a form of fees. Generally speaking, the index funds are cheaper compared to mutual funds and have a performance record of about 10% return and sometimes even higher because they generally mirror the market. For example, if you pick the Vanguard's S&P 500 index fund, that one mirrors the S&P 500 index. That has performed an average of just under 10% for the past 90 years. While there's definitely room to make profit in the short term in the stock market by just buying and selling stocks, buying low and selling high, but your long-term goal should be the most important one. I have a video on compound interest, and that's really the best way to become wealthy using the stock market. I'll link that video in the description below. Think of your goal for retirement as a marathon and not a sprint. Most of you watching have plenty of time to accumulate compound interest on your money. Make investing a habit now so you can live comfortably later. And that is a basic concept of the stock market. Let me know what you think of the video in the comments section below. Thank you for watching. We'll see you next time.